Hello and welcome to ETF Pulse, ETF.com's podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com. Here as always with my co-host, Nate Geraci, president of Nova Diaz Wealth Management. Let's take a quick look at the Pulse rundown. So we have new launches from WEBs or WEBs. I know Nate and I are going to debate that. We'll be chatting exactly what these are and what they mean in this sort of, well, Nate was calling it boomer candy. So we're going to discuss. And there's a bit of controversy around SBIL. We'll be chatting that if there's going to be some innovation or actually just some fee grabs going on. And then we're going to be talking about the SEC essentially staying the Bitwise crypto ETF launch despite it already receiving approval. Then option income ETFs. I know that you've heard all about it. I've seen it a ton lately. Are they just popular? Do they actually offer something good in terms of yields to really drive some of that popularity? And then last up to round out the show, Nate and I are going to take a little bit of a debate about some of the top 10 ETF issuers and if we think that BlackRock can be unseated as the #1 ETF issuer. We're talking by AUM, by the way. I actually didn't realize, Nate, if you meant by popularity, by revenue or what, but BlackRock is still #1, no matter how
We
many.
make our own rules on this podcast, so we can
Absolutely.
debate whatever.
So we'll be chatting about that to end out the show. Anyway, hey, Nate, how are you?
I'm doing great. Two boomer candy topics this week, in my opinion, with the WEBs ETFs and then the options-based
Option incomes?
ETFs.
Yes, yes,
Yeah.
yes, yes. It was actually funny because as I called it boomer candy, I was like, option incomes are also some boomer candy. All right, so let's talk about WEBs. So the reason we were talking about this is because there's a defined volatility ETF suite of ETFs that are launching. There's going to be 11 of them, I believe, 11 sector funds. We've chatted about this before when we talk about like buffer ETFs, more boomer candy, but defined volatility that essentially is allowing folks to really kind of like take advantage of risk to the upside, but also mitigate that risk at the same time. You call it boomer candy. I'm actually curious to know why. I know why I think it's boomer candy, but do you actually think that there's no interest? Do you know what I mean? In a younger investor looking into this sort of product? Or do you think that those younger investors are just going straight for the full risk on products like leveraged and inverse ETFs?
Okay, so a few things here. First of all, these are actually live. They launched last week, so these ETFs are out there on the market now. And what they're doing is they're looking at the volatility of each sector spider.
Mm-hmm.
And basically, when volatility is lower, the ETF will increase exposure to that spider ETF. And then when volatility spikes, it reduces exposure and will go to cash or US Treasuries. So again, if you just think about all of these sector spiders that are out there, that's basically what the underline is. That's what it's looking to. But
Yeah,
to
they have defined volatility rates. So you have something
yeah,
like XLK, which we already know is the sector spider for tech. Then you have DVXA, excuse me, which is the WEB's defined volatility XLK ETF. And that one actually has a defined volatility rate of 30%. So the range between the defined volatility rate is anywhere between 20 to 30%, depending on the sector and the fund that we're talking
yeah,
about.
like the more volatile the sector traditionally has been, the higher that volatility, that
Yeah.
defined volatility rate is. But yeah, look, these are definitely boomer candy because these fit right into the trend of having exposure to the markets, but with that sleep at night factor. These
Hmm.
sort of remind me of like defined outcome ETFs or even some of
Yeah.
the covered call strategies, which we can talk about, because what they're doing is they're basically putting some guardrails on your exposure to the markets. I do think clearly that's been attractive to uh, we'll say retirees or pre-retirees. I don't know if younger investors are going to be as interested in this because that's a whole different generation. I mean, that generation now has gotten used to crypto and everything else where I don't even know that they're going to be content having 9% return to stocks every year, if you look at the
I mean,
historical return to stocks.
I'm actually glad you really say that because I think that if you are an investor and you are new to investing anywhere from, let's just call it 2019, right? Let's actually go a little bit pre-COVID because we did see so many investors come to the market during that time period. I mean, the markets haven't given us 9% returns. They've handily beaten that, right? I mean, this is, I guess, a generation of the meme stock trades, the HODLs, diamond hands, like the Reddit bets, where it's been very risk on. But I'm curious to know what your thought is. At least, okay, so fine. We won't see a lot of younger investors get into this, but we might maybe see newer investors that are a little bit hesitant and fearful about getting into the market find these products sort of interesting. But I'm curious to know for those, boomers or at least older investors that are saying, "Hey, I like risk, but I can't take that much of it, right? This is my retirement, that I have to kind of pull down." And we've talked about this before, right? There are ways to mitigate risk inside of your portfolio without necessarily going to some of these like defined outcome ETFs or defined volatility. So, how do you think about them, like putting on your financial advisor hat? How do you think about a product like this in the context of a portfolio for an older investor? How do you think about having that conversation with an investor who says, look, I actually would like to still gain, have some upside gains, but I don't want to take on that much risk. Do you
Yeah.
point in this direction, or do you say actually there's better investment strategies available?
Well, I'll answer that in two ways. Just at a high level, I've always struggled a little bit as an advisor with these products that put guardrails on certain areas of the
Mhm.
market because I'm a believer, and this is just me, that I can control that risk profile with proper asset allocation.
Yeah.
So, in other words, if somebody can't withstand, say, a 30% or 40% drawdown in stocks, well, then you have to target their portfolio in a manner that doesn't happen. And you can do that with the right mix of stocks and bonds and potentially some other assets. So just at a high level, I've always been a little bit hesitant. And by the way, I can do that very cost effectively
Hmm.
with the existing ETF universe. With these WEBs ETFs in particular, where they're targeting a sector, the challenge that I have is that if you're going to make a sector bet, I feel like you have conviction in that sector, right? Not everybody looks for sector exposure in a portfolio. A lot of investors go broad based, but if you're going to target a sector, I would think that you have conviction around that. And so why would you attempt to put some guardrails around that? And then even
Yeah.
if you look within the sector, like, okay, I get it, the communication services or technology, those things theoretically can run or fall really hard. But think about, say, consumer staples or utilities, which are much more defensive in nature. I just think that if you're going to then enter into that position, that's what you're looking for. You want that defensive aspect of the sector itself, and you don't need additional guardrails around that, if that makes sense. So I don't know that investors are going to look down to the sector level and want to have some protections in place.
Yeah. I mean, I mean, I agree with you. Every time I talk about, like, I'm just thinking buffer right now, right? I just think, is this a product that people really need? And I also think that they tend to be billed as products for everyone, right? Like, if you're someone who wants upside gains but wants to manage risk, I mean, I'm just going to read the quote, right? From the CEO that was a part of the press release from Ben Fulton. He says that these ETFs can be used tactically for sector rotation or to fine-tune exposure within a broader portfolio. In today's market, it often feels like you're forced to choose between managing risk and pursuing growth. But we believe you shouldn't have to choose. We believe you can have your cake and eat it too. And I actually don't think that's true necessarily. I don't think that
You're saying the cake and eat it too part?
I don't think that investors are being forced to choose. I think that there is a way to manage your portfolio in such a way that you can still pursue like aggressive growth and then still also manage risk without necessarily needing this specific product to do it for you.
Right, but I'll take the other side of that and just say, I mean, what ETF issuers are trying to do is package up solutions.
Yeah.
And that's what this is. So you're right. I mean, I'm talking out of both sides, but whether we're talking about these Webb's defined volatility ETFs or defined outcome ETFs or cover call ETFs, which we'll talk about, which theoretically can mitigate a little bit to the downside. It's all about packaging up solutions to investors where they have some idea as to what they're going to get. And I think that's what Ben Fulton is saying with, have your cake and eat it too.
Well,
My only, what I would agree with you on is that I don't, generally in investing, you really can't have your cake and eat it too. Like you're giving up something. There's no risk, no reward. There's
yeah,
always a balance between those two. Now,
Econ 101 teaches us
yeah,
that there's
I
always.
will say, yeah, so I was just going to say, I do think it's important to note that Webb's has similar ETFs that track broader indices. So they have one that basically tracks SPY, and they have another one with the triple Qs. And those, because those are broader based, I could see having more of an audience. They've been out there. I haven't checked assets recently, so I think they're still fairly new. The broader ones I could see having an audience because we've seen that again with defined outcome ETFs and some of these other segments. So we'll see. I'm a broken record every week on this podcast because I keep saying ETFs. What
Or a
everybody
meritocracy. I was going to
repeat
say
after
that. I
me.
was
Yeah.
actually going to say that just now. I was going to end it by saying, well, as you always say, ETFs are a meritocracy, and may the best ideas win. And if people want the product, then they will purchase the product. They will vote with their wallet.
And Ben Fulton is a true ETF innovator and pioneer. He's been around the block many, many times. He knows the space. So I'm rooting for them. I hope they have success. I do think at the sector level, at least, it might be somewhat difficult to find a big audience.
We'll have to see. All right, let's talk about Simplify. So I'm going to read part of how it was explained in the article that we have on our site, just because I think it was like nice, neat, and succinct, and it would get too muddled if I tried to just go for it. So here's what essentially happened, right? So
This has been a hot topic too
yeah.
here in the ETF space.
So Simplify launches SBIL, which is the Simplify Government Money Market ETF, right? So money market ETF, it invests in the short term, government securities, repurchase agreements. Okay, so right, that on its face, nothing new. We have a couple of money market ETFs that have launched. Uh, Texas was the first one to, what is the name of the issuer now?
Texas Capital.
Texas Capital. There we go. I know I just have Texas in my head. I just kept seeing the Lone Star State. Texas Cap was the first one to launch the money market ETF, MMKT, but now we have SBIL. Okay, so you think, all right, we've just got another money market ETF, right? That's hit the market. Wrong. Wrong. Okay, so here we say, okay, it amassed 2 billion, right, in AUM within days, which is a huge amount of number. But those flows did not come from investors and instead came from within Simplify itself. That they used SBIL as a sort of cash management for their liquid funds that they have and their holdings. That is for several of their other ETFs, like CTA, which is the Simplify Managed Futures Strategy ETF. So essentially, they moved what they should be doing internally within the organization and wrapped it inside of a separate product and are now charging anyone that invests in it 15 basis points for the privilege. And this all kicked off, I mean, I guess a shout out to Dave Nottig, who kind of really flagged this on Twitter, and really sort of, I guess, stoked some of the fires around this sort of controversy. So I've laid it out.
You did
Thought.
a pretty good job there. Yeah, and Dave Nottig, I think many people know, he's a longtime industry veteran. He
Yeah.
actually wrote a longer form Substack, blog or piece on this. But a couple of things here. So the fund itself charges 15 basis points, which does make it, I believe, the lowest cost money market ETF out there. Remember, BlackRock has a couple of money market ETFs out there. You mentioned Texas Capital, but to your point, it's funny because when this launched a few weeks ago, I think I track ETF lows very closely.
Yeah.
I just every week.
Did you go, whoa?
Yeah, I mean, I saw that it pretty quickly had over 2 billion in assets, and I just assumed that they had money lined up for this. Like they had investors, which even that would have been a tall order for money. But I just assume, Simplify, they have a ton of smart people over there, very innovative shop, and they know a lot of people. And I just thought maybe they had some institution or whatever lined
Yeah.
up. I just didn't put two and two together and realize that they were using this in their other ETFs. And so, as you mentioned, they are using this as the cash management sleeve in several of their products where, say, they own futures contracts and they need to have collateral on hand. That collateral is parked in basically cash equivalents. And previously they were using treasuries and some other stuff. And instead they've now plugged this money market fund in. And I guess my hot take, or maybe it's a warm take. I do have mixed feelings on this in the sense that I truly like Simplify ETFs. I like their leadership team. I've had numerous interactions with them, and they genuinely seem like good people trying to do the right thing and very smart people, as I mentioned before. On the other hand, I'm a very big fan of transparency.
I knew you were going to say that.
Yeah, and so I
I knew you
think
were going to say that.
here's the issue. Just adding this to existing ETFs and now investors are paying an extra 15 basis points, it's just not great optics.
At
And
all.
so if you're just from the outside looking in, it looks like double dipping or whatever you want to call it on fees. Now,
I mean, it kind of is, I think.
well, okay, but as we were in with the previous topic, I try to think about things from multiple angles. And so let me take the other side of this for a moment,
Okay.
because I'm guessing that Simplify would argue that SBIL will, I guess, either A, generate a higher return or yield than what they were previously doing, or maybe there's some efficiencies there in how they're managing the cash. And so perhaps net of fees, investors are still better off, if that makes sense. Even if they're paying that 15 basis points, that maybe they're going to squeeze out that 15 basis points in the return of this money market fund. And so I do think we have to acknowledge that. And then, if you don't mind, ETF.com, you guys had, I thought, a really balanced take on this. Was it Samit
Yep.
Roy who wrote the
Roy
article?
wrote it.
So
Yes.
if you don't mind, I actually want to read something from that. So this was from Simplify. Okay, they said trading individual securities in the short space across 30 plus ETFs is cumbersome, and there's transaction costs and operational costs that add up. What we're trying to do here is not only enhance the yield, but then by cutting down on some of those operational costs and improving the efficiency, it should offset the additional cost and benefit of all of our strategies over the long run. So what they're saying is, if they have a cash management sleeve in a number of their ETFs, instead of having to go in and individually manage each one of those, they can just plug in SBIL, and then they're just managing that through one fund.
Right.
And so that makes sense to
And
me.
increased efficiency always usually lowers costs.
Yeah. And so but what you just said, I think is the important aspect here, because if you are cutting down on operational costs and improving efficiency, theoretically, that means the ETF should be cheaper to run. And if the ETF is cheaper to run, then maybe investors should benefit.
I think the word theoretically that you just said is doing heavy lifting in that sentence.
Maybe, but Kirsten, I try to take a balanced approach here. And even though I mentioned I really do like the Simplify team, I don't want to let that interfere with how I look at things. And I try to see both sides. I'd actually love to hear from, I mean, I just read a quote from them. It'd be fun to talk to them and just hear their explanation. But yeah, again, it's not great optics. However I want to slice it or you want to slice it, it's not great optics when you have investors that all of a sudden have an extra 15 basis point fee that felt like it was slid in there.
So, okay, I also want to read. I was going to read the quote from Dave that he kind of put on Twitter, but I'm glad that you did read the response from Simplify, which I want to make sure that we do also mention. But I mean, I just felt that Dave said something it feels like when you hear it, you're like how do you come back from that, right? And he said, quote, "So as far as I can tell, what they've done is take a service they used to provide inside of each fund, cash management, and found a way to charge an extra 15 basis points. So pure greed with a side order of grift." which obviously I think implies a level of malevolence and manipulation on the side of Simplify that I'm not going to go as so far as to assume in this scenario. However, do you think you would feel better if you felt like some of the fees on some of the other ETFs were cut as a part of this whole
Yeah, and that's what I was saying. If
move?
if Simplify is gaining operational efficiencies out of this, because again, they don't have to go manage the cash management
Hmm.
sleeve in all the ETFs we're using, then yeah, I do think that would justify potentially reducing fees. On the other hand, Simplify is a for-profit business. And that's
Yeah.
where I come back to it. For me, it's like transparency and being very
Yes.
public about this. And I thought Dave's piece, I love Dave, by the way, it was pretty sharp.
Yeah.
But
It
but I
100%
also,
was.
but I do think it's good and that we have people in the industry that are comfortable shining a light on these sorts of things. And I
Yeah.
think that's good in any business. It could be in businesses that I'm involved with. You should have a conversation around things that maybe um, don't look great from the outside. And
I mean,
so I think
this
it's good.
was a
I
good
think it's good to
lesson.
have
I
that
think this is
debate.
also a good lesson in PR. I mean, because I think if there had been a press release that had been put out and it was like Simplify has found a really new innovative way to actually lower fees on these products, right? By running its cash management through SBIL. As a part of SBIL, which will charge 15 basis points, which is lower than the other money market funds, which charges 20 to 25 or 20 to 30 basis points, I believe,
Something like
some
that.
of the
Yeah.
others. For some of the others, they say we're going to charge 15 basis points, and we're also lowering some of the other fees on the other ones. Or we have a scheduled plan to lower fees as we achieve operational efficiency on these ETFs and can therefore start to lower costs, right? And so
100%. And maybe
that
that's been
over,
their plan all along, but I think you're hitting on something good. Yeah, communicate that, right?
yeah,
But it gets back in, I'm a broken record, it gets back into the transparency. Like say, here's the roadmap, here's what we're doing.
yeah,
Otherwise, you're leaving the market to just assume that you do have nefarious
intentions.
intentions here. Yeah.
Yeah, yeah. All right, let's move on to cryptocurrency because the SEC made a decision to I guess place a stay, delay. It's already been approved. Okay, so the Bitwise 10 crypto index ETF conversion was already approved. That launch was already approved by the SEC, and then the SEC said, "No, hold on." Which, by the way, I feel like we're seeing this a lot lately with the SEC. They prove things and then they go back and they say, "We have concerns about this fund that we've approved months ago." I think we saw that happen with Priv. That happened. We're seeing this. I feel like I'm just kind of seeing this happen more often. And I don't know if I just didn't pay as much attention to certain regulatory decisions in the past of the SEC, but it feels to me like it's something new, right?
I think it's reflective of ETF issuers pushing the
Yeah.
envelope, right? They're really trying to see what they can get out there. And so, yeah,
Yeah.
we have seen this a couple times, but
Yeah.
uh,
Grayscale had their launch delayed as well. They had a diversified crypto ETF earlier in I think July, end of June. This also happened, or the SEC sort of delayed it. But in this fund, it's going to be holding almost 80% Bitcoin or 80% Bitcoin weighting, over a billion in AUM. But essentially, yeah, now we have this sort of delay. I'm not entirely sure the entirely all the reasons why
I
behind
think, yeah, I think I
if
can
we and what
offer,
we think that it says, right? What we think this delay really says about the SEC and how they're approaching some of these products.
I can't remember if we talked about this with the Grayscale Digital Large Cap ETF a few weeks ago. As you mentioned, the same thing happened, but
Mhm.
let me explain that in a little bit more detail. So the SEC Division of Trading and Markets, they approved this ETF under what's called delegated authority. I'm not going to get in the weeds. All that means is that the SEC staff was making the decision here. There's not some vote among the SEC commissioners. And this is pretty standard. Okay. So the Division of Trading and Markets, they approved this thing, this Bitwise ETF. And then immediately the SEC Assistant Secretary, they issued a letter putting a stay on the approval order, which just means the approval was paused or suspended.
Mhm.
The problem is that Bitwise, and again, same thing with Grayscale, they follow the statutory process to bring this to market. In other words, they filed everything properly, they waited their 240 days or whatever, and then the Division of Trading and Markets approved it. So that should be the end of this thing. And so if you're wondering what happened, and I'll give credit, Bloomberg's James Seyffert, he floated a couple of theories, which I actually agree with, but those two theories are that one, the SEC wants to finalize a framework for spot crypto ETFs, which you and I have talked about, right? This is something the SEC is working on to make it much easier to launch crypto ETFs. And so the thought being, well, let's have that in place first before we start letting crypto ETFs come to market that hold things like XRP and Solana and some of the crypto assets. So that's one theory. The other theory is that there is a single SEC commissioner, which I will name, that is throwing a wrench in things here. And he's referring to Commissioner Crenshaw. And she's been very, I guess I could call her a crypto hater. She's certainly been.
I would say she's quite anti-crypto.
Yeah, anti-crypto is a better way
feels
to
feels
put
very
it.
much of a holdout from the previous SEC.
Yeah, and so, but the reason she can do that is because this was approved with delegated authority. My understanding is that any one commissioner in that scenario can come in and go, hold on, we're going to hold things up here.
Yeah.
And there's no process around that. In other words, they can hold it up indefinitely. Now, I don't think that would happen. I don't know that the other SEC commissioners, at some point, it would come to a head. But one commissioner can hold up the show here. My gut is that's actually what's happening. And the reason why I say that, Kristin, is very simple.
You don't think it could be an and scenario? Because I actually think, I think it's a little bit of both kind of thing.
You're right. Maybe there is, or there are elements of both, but you mentioned Priv. Now let's think about this. Priv can own 15% in illiquid assets like private credit. If you look at the composition of both the Bitwise and Grayscale ETFs, over 85% of the holdings would be in Bitcoin and Ether, which the SEC has already approved in an ETF format. So let's just call the other crypto assets illiquid. What's the difference between that and Priv? It's the same thing. If you're going to let illiquid private assets trade, then let's let illiquid, which I don't think XRP is illiquid or Solana is liquid, but if that's what we want to characterize them as, great.
I was going to say, I was like, I don't know if I would characterize them as that.
But... And so because of that, I have a hard time getting my head around that. The other thing too, which I get fired up about, this, we have futures-based XRP ETFs already in the market, leverage futures XRP ETFs.
I think
we have leverage Solana ETFs.
For me, that's the hardest thing to wrap my head around.
It doesn't make any sense.
I'm trying to figure out for the SEC where the sort of line is between what they're going to approve and not. Excuse me. It just feels as if and I actually think that what I'm about to say applies regardless of those two kind of theories you threw out there, whether it's, Commissioner Crenshaw holding things up or whether the SEC has decided, listen, actually, we need a framework, right, before we approach these assets. I think that you either say, we are going to make approvals and actually approve some of these products that come across our desk within the time frame that we are legally, obligated to abide by when it comes to some of these deadlines, or we come out and say that we are going to delay decisions on future products that fall under this category until such a time that we have really fully positioned ourselves in a regulatory framework as the SEC.
You know what that is, by the way, that you just said? There's a word for what you just said. You know what it is?
Transparency.
Transparency. We have a theme running here and some lessons in PR. I've come very prepared this week. So I have another quote for you. And this is courtesy of Bloomberg.
Okay.
So this was from an attorney, and he was referencing this entire story. So I'm going to read this to you. He said, this reflects the internal disarray at the SEC around digital asset policy. The public sees conflicting actions, approvals followed by sudden reversals, which creates confusion and undermines market confidence. I cannot have said it better myself. And that's what you're saying.
I 100% agree.
Optics, transparency.
In my mind, we're either doing this or we're not doing it, right? And if you're not doing it, say why you're not doing it, or give guidance on how we might be approaching it in the future. Or you just,
Yeah.
because then it obviously, to your point, if you are an issuer that's trying to bring a crypto product to market, you have no clue what you're going to get from the SEC. You might get an approval, you might not. You might get an approval that's then delayed. You might not get, like, you have no clue. And I just think it makes it incredibly difficult to innovate around cryptocurrency or any sort of digital asset as an issuer and to help bring some of these products to market for investors if you have absolutely no idea what you're going to get from the
Yeah,
regular.
and again, you undermine, you being the SEC, your own credibility, because you have idiots like me out on Twitter or whatever saying this is ridiculous. And it's not just me, there's plenty of people saying this doesn't make any sense. It's contradictory. How do
Yeah.
we why do we have leverage XRP futures-based ETFs and we don't have a single spot XRP ETF and all those sorts of things? It's just you have to be transparent and um, think about how the optics, how you're presenting to the public, and they're not doing a great job here, which is a little disappointing because the expectation was that this SEC was going to be much more crypto friendly, and I
Absolutely.
think they will be, and they are, but
They
they
seem
look a
crypto
little,
friendly, but also crypto confused, if we're
yeah,
going to
it's a
be
little
honest.
disorganized right now
Yeah.
for sure.
Yeah. All right. So now I don't know if I want to call this the debate hour of the of the thing, because I don't think we're gonna have a debate on this next one. But I just really wanted to chat for a second about Boomer Candy number two, which is going to be options income ETFs. I am just seeing a ton around option income ETFs. And I've also gotten inbounds. We've gotten inbounds on social media, whether it's Twitter, whether it's Instagram, where people literally drop specific tickers of option income ETFs and they're like, is this a good idea? What do you think about it? And I feel like I see more and more of this. I know they exploded in 2024, but for some reason, and it could just be, again, sort of a confirmation bias that I'm now paying way more attention to it in 25 than I did in 24. But it feels like there's been a ramp up of it this year. And I think that it's no mis I don't think that it's a coincidence that we're seeing the explosion of option incomes ETFs at the same time that we also see this explosion of like your buffer ETFs, your defined volatility ETFs also at the same time. Like there is this like need in this market right now that we're in for some reason in particular where it's like I want the risk and the upside, but and in terms of option income, like I want regular cash and I'm willing to give up some gains for it. I don't know. I'm curious to know what you think is sort of driving this popularity lately behind these products.
I'm probably a poor messenger on this topic because I don't know if you know this or if you remember this. I called this entire category a bubble in January, not of this year, of last year in
Oh,
2024. I said this entire category was a bubble. I thought there was too many products coming to market. And now looking back, that call alone might cause you to strip me of my Nostradamus
I mean, because the bubble has
label.
not at all
Yeah, that's
come
been a
close
really
to
bad
her.
prediction.
Yeah.
Um, I actually do still think the space is a bubble, but it keeps getting bigger. And I'm a little surprised here. It kind of goes back to what I was saying before on the Webs product. I'm always or I've always just been a big believer in there's no free lunch in the markets.
Hmm.
And so on some of these covered call ETFs, they're advertising these ridiculous yields.
I've seen
And
100%,
yeah,
20%. They're all over the
but well, we can unpack that. I mean, there's people need to understand some of those products are just returning investor capital, like giving you your own money back to keep up the high yield. But the point is, if you see these high yields, you're either taking on risk to get those, or you're giving something up in the way of return. Like it's that simple. Those are the levers that are being pulled. You don't just get a higher yield for free. I feel like that's basic, 101 in investing. And I'll give you a good example. I was looking at the high yield Tesla option income ETF, which I don't have the ticker in front of me, but I ran the performance since inception. This was yesterday. This
Hmm.
thing underperformed Tesla stock itself by over 70% since it launched.
Okay.
70%.
Begs the question, right? Like how some of these yields are even possible, right? Right. When you look at some of the underlying assets, you're like, how these some of these yields are not sustainable.
Yeah, I mean, they are, it just depends on the volatility on the underlying and what kind of option premium they're able to bring in, because all of these, or most of these, are covered call strategies, right? So they're selling that upside, they're collecting a premium, distributing that to you, the investor. But if maybe they're short on that, then they'll return some of your own capital as well, which is nice because you don't have to pay taxes on it at that moment in time, but it reduces your NAV. And when you ultimately sell, you'll have to pay taxes. But, um, it's kind of like that financial engineering we talk about. And I don't, clearly there's an audience for this. Clearly people like the idea of having this income stream coming in.
It's
I
actually
would
funny
just,
you mentioned that one. I was actually looking at MSTY. I feel like that's the one that's super popular, which is the yield max
the strategy.
MSTR, the micro strat,
Yeah.
yeah, yield max micro strategy, option income strategy, ETF. I mean, I literally just I pulled micro strategy, which is up about 31% year to date, and MSTY year to date is up just under 33%. So I mean,
Yeah.
a
And
slightly
hopefully you're
a
looking at
slightly
total return
outperform.
there. Make sure you're looking
Yes.
at total versus price. But regardless, the point is, if you look at a lot of the products like that, that's what you'll see is they're significantly underperforming the underlying. And that's not their stated goal is to not outperform the underlying stock. I just think people need to consider that when they see these juicy yields out there. What are you giving up? What risk are you taking? And you can't just look at this headline yield and go, oh, this is great. I'm going to get a 70% yield in my portfolio. It's not that easy.
Do you think that there's something about the market that we're in right now that is kind of driving this sort of interest?
That's a really good question, because I think my intuition would be to expect the opposite, because I
Right.
feel like we're in a risk-on market, and we've been in a risk-on market over the past 2 years. So if anything, I would think you would want to own the underlying direct and not sell away some of your upside.
Correct. Yes.
Yeah, so that does surprise me a little. I'm not quite sure. Um, I really, again, maybe it's just the boomer candy. It's that simple that you have
I mean,
people.
we we are risk on, but then we also still we are facing certain risks in the economy and therefore and also in a way the market going forward, especially for the back half of the year.
Yeah, but remember, if that's the case, you still have downside with these ETFs. So yes,
You're
the
not
income
making
that
this.
you get in from covered calls can offset some of that, but you still have full downside to the underlying itself. So I don't know that that would be a good reason either. Yeah, I don't. This is
Good
just
point.
one. Again, the market's telling us there's demand for these and investors want them. I can't quite put my
Yeah,
finger
and
on
not just
the why
demand.
though.
I would actually say almost like rabid demand.
Yeah.
Personally,
Yeah,
I mean,
Yield
I
Max has
cannot.
had an unbelievable, last year and a half or however long it's been. I mean, they're
Yeah,
lighting it on
I
fire.
just decided to pull up the fund flows right now. Just again for MSTY, that Yield Max fund. I mean, last 3 months, 3 billion, year to date, almost 5 billion. For the last year, over 6 billion.
Yeah, so good for them. And clearly, again, there's an audience. People want these.
Yeah. All right. Well, I am actually curious to know if and when that bubble bursts. I don't think it's going to be for a while, personally. If I had
It
to give
doesn't
a
look like
prediction
it.
on it, despite you mentioning that January 2024, I'm like, what year are we in again? I don't think that we're anywhere close to that bubble bursting.
Real quick before we move on, what's funny about that is in the prediction that I made in January 2024, really the reason why I said the bubble was going to burst is I said if the market continues to move higher, and I was thinking of like a product like Jeppy.
Yeah.
I was like, it's going to continue to underperform because this was following 2023 when Jeppy significantly underperformed the market. And I felt at some point, if the market kept going up, people would go, well, why am I selling away my upside? And the exact opposite has happened, right? The markets continue to go up and people have kept piling into these products and underperformed. It's I've gotten it completely wrong. I don't know. I just
I think part of
clearly I'm
that
at a
is
loss of
just
words.
I think it's just investor psychology.
Yeah.
Right? I think that at scale, you might be thinking very differently about the market and the approach in the portfolio than some other investors might be, right? I mean, I think it is nice when you look down, you get the little alert. At least if you're in Robinhood, you get a sort of alert, which is not my main. It's not my main brokerage. I have to say that, but it is nice when you get a little alert and you're like, "Congrats! So you've got
Oh,
you
so
know.
you like the confetti and all that. You just outed yourself as a Robin Hood confetti fan.
It's like gives you a little notification. It's like, congrats, you got $9.23 to your account for this month for given to you by whatever it is, right? Jeppy or MSTY. I mean, and you think, yay, $10. Look at me. And then your
Maybe that's where all the
it
demand's coming
continues to go
from.
up. I
Yeah.
don't know, that might be part of it. All right, debate time. So we were talking, you threw the gauntlet at me to look at the top issuers, particularly the top 10 ETF issuers. Again, we're doing it by AUM, but we could probably cut it, slice it, and dice it in other ways as well. Revenue, how many funds they have, or how many ETFs they have. But the top 10 ones, who we think, or when we think Vanguard is going to unseat the number one, the one holding the crown, which currently right now is BlackRock. So it'd be iShares, is their sort of ETF arm. And who we think is going to drop out of the top 10 and who's going to go into the top 10. So I figured I'd quickly read at least some of the ones in the top 10 so everyone can kind of.
Yeah, go for it.
Number one, we have BlackRock. Two, Vanguard. Three, State Street. I think no surprise there that those are the big three. Number four is Invesco. Five is going to be Schwab. Six is JP Morgan. Seven is First Trust, which actually moved up from its number 8 spot, which is now taken by Dimensional. So Dimensional and First Trust flipped on this list, at least again when it comes to AUM. Number 9, we have Fidelity, and then number 10, we have the World Gold Council.
Yeah, which is really under State Street. So I'll go.
Correct, right, because it's
Who's 11?
GLD.
Yeah.
Going to be GLD, which is under State Street. So let's go to number 11, which would then be Van Eck, if we want to consider that the full true top 10. Okay, so I run a couple of things to kind of just context setting as a part of this. AUM for BlackRock, we've got 3.6, or I should actually say, I'll give their exact numbers, 3.587 trillion. 3.43 for Vanguard. So they're close. They're quite close to each other. BlackRock has 466 ETFs. Vanguard has 97, which is really saying something there. There's a lot of efficiency that's going on when it comes to the return on investment, at least on Vanguard's side, at least for how much their ETFs can really drive some revenue. When do we think Vanguard will unseat BlackRock? I don't know if I have a time for it. I think it is possible. I do. And I think it really all comes down to how well crypto and how well Bitcoin continues to perform in the back half of the year into the first half of next year. Because you have, I would say, between those two issuers, you have IBIT. It's almost like in my mind, and this might not be the right way to think about it, so I'd love to hear your thoughts, but in my mind, it's almost like IBIT versus VU is like the kind of like face off that we sort of have going on here.
Do you think it's inevitable that Vanguard passes iShares?
Yeah, I do
You
actually.
do.
I
Okay.
do. I do.
Because people have been talking about this for a while now. And if you look this year, Vanguard is once again taking in more money than BlackRock. Though I will say, if you look at those flows, it's not a complete landslide. And I was looking over the past 3 years. Vanguard's taken in about 100 billion more than BlackRock over those past 3 years, which that sounds like a ton of money, and it is. But we're also talking about companies who have brought in 600, 700 billion over that time. And so, that's not, the 100 billion is not a huge amount. And right now, I think, as you were saying, what is it, 150 billion difference between the two?
150
Okay.
billion. Yep.
So clearly Vanguard still has some work to do. And
Yes.
my gut would
I don't
be
think this
that,
is a next 6 months, this year situation. I think it's in the next couple of years situation. I also think a big differentiator will be if Vanguard actually decides to catch up with the times and actually launch something in crypto, because
yeah, and
they
that's,
have firmly held out. And I actually think that it is to their, I don't want to say peril, but I do think it is to their downside that they
I
are
think
refusing to enter into that space.
I think the issue with that is not so much the lack of flows or getting into, say, a Vanguard Bitcoin ETF.
Mhm.
It's the perception from younger investors
Yeah.
as to who Vanguard is and what they represent.
I
And
mean,
so
yes,
boomers are going to
it is
continue
in
to
a
put
way like
money.
iShares in that if you think about it, Vanguard does seem like your grandfather's issuer and BlackRock is your issuer, right? I mean,
Yeah.
and that's why I almost set it up that way. It's like in my mind, it's like almost like IBIT versus VU, and wrapped up into that, it's like old generation versus new. But and even like an investment strategy, which they're not necessarily different, but it almost feels different in some way. Again, talking about that sort of psychology where it's like the buy and hold for long-term strategy versus the, more risk on, more aggressive kind of like strategy.
I don't even view it as that per se, because BlackRock or iShares, they offer all the same broad-based type products that Vanguard does, and you can dial in, up your risk up and down as you see fit.
Mhm.
But I think it's just more, it's the theme of the show. It's optics, in that if you go right now to the homepage at iShares, I was looking at this last night while I was standing around in the kitchen. Up at the top, you will see there's like a banner that says something, hey, you want to learn more about Bitcoin and Ethereum? Click here. And then if you click on that link, it will take you to a landing page that lays out all the rationale that, why you may want to own Bitcoin or why you may want to own Ethereum. And I think that definitely makes a difference with younger investors. And so what I was going to say, Kristin, is that there's no question Vanguard's going to continue to vacuum up money. Boomers and a lot of other investors are going to continue just allocating dollar cost averaging into Vanguard ETFs, et cetera. But at some point, that wave of money from the younger generation, whether it be as they earn money on their own and save money on their own, or you have this huge amount of wealth that's going to be transferred, from boomers, down to the next generations. That's going to make a difference, and I think that could show up. So, you know what? I could actually see, I'm going to play both sides, but I think you'll appreciate this. I could see a scenario where maybe Vanguard does catch BlackRock in the shorter term, and that only to see BlackRock circle back around and
Take it
catch them
back
longer
again.
term. Yeah.
In that scenario, then there would be some sort of not necessarily conversion, but right, like people start moving over from Vanguard, especially if again they're inheriting that, well, in terms of that wealth transfer. I'm assuming you're inheriting it from Vanguard, right?
Yeah.
Like
I'm telling you, and again, it's still small in assets relative to the entire ETF universe, but I interact with these people out on Twitter and X who are very crypto centric, and this group does not like Vanguard at all. I mean, they're almost, there's like animosity there, almost like anger at Vanguard. Now, Vanguard might end up being proven correct if all of a sudden the entire crypto space craters 80 or 90%. They're going to be doing a huge victory lap. Um,
I mean,
but if we put that aside, yeah, I think at some point, I like the way you frame it. It looks like sort of your grandfather's asset manager versus,
right.
a
You
hipper
and your
asset
friends.
manager.
Yeah,
Yeah.
exactly. We don't even need to talk about the rest because State Street's coming in at 1.51 trillion. So I mean,
Yeah. I don't think anybody's catching
no
those
one's
two.
catching either one of them. But I do think it is inevitable that Vanguard does clinch it because I think that no matter what, no matter how um, progressive BlackRock, seems, as you were mentioning, BlackRock does offer a lot of the same products, cover the same indices that Vanguard does. I just think that I think that people just kind of tend to go to Vanguard for those kinds of products, right? Like if you're going to invest in an S&P 500 fund, I think of just going to Vanguard. I don't think about, or I think about State Street, but I'm not thinking about going to BlackRock for that type of product. When I
Yeah. But IVV, I mean, that's the
No,
second
I know
largest.
it, and it's number three. It is the third biggest S&P 500, fund, and it has actually made some big, at least when it comes to flows, like very big leaps. As you know, we were kind of talking about SPY versus VU. IVV was not too far behind, and then the question became, when is IVV actually going to eclipse SPY? Um, but Vanguard is just like hoovering in a
They're
ton,
a machine. Yeah.
like on some of that stuff. All right, next question, which you had posed was, which issuer do you think is going to fall out of the top 10 and which one's going to move in? I have
Um,
I've been looking at the list and
the,
I have a I
Go
have
ahead. What do you have?
I thought it was Cap Group. which isn't.
Cap group to move into the top 10.
Yeah, Cap
Yeah.
Group is sitting at number 15 right now. If we were to look at the next five after the top 10, remember VanEck's kind of number 11/10. You've got ProShares, you've got Wisdom Tree, American Century, Cap Group, Murray and Rafferty and Goldman.
Yeah.
That's
I actually like the cap group pick a lot
it.
because, I think this year, what are they like number 7 in flows? So you said they're 14th or 15th overall, but if you look at flows, they're way outperforming
Yeah.
where their rank is, and they've only been around.
They're number actually five in flows.
Okay, so even better, and they've only been around for a little over 3 years.
Yes, they're a
And
very new, like pretty fairly new to the scene. Um, they used
yeah, but they
to,
have massive distribution, like
yes.
absolute massive distribution, and a strong pedigree name brand. So I like that. I would agree with that.
Yeah, I think they have a pretty good brand name. I think that they've got I always just keep hearing about new funds that they're launching, new like innovative funds that they're launching. They do growth, they do dividend, they do value. They've got pretty good actives as well. Yeah, I when I look at the list of like the next ones that I think are probably most likely to kind of jump up into the top 10, yeah, for me
I
it's
agree. I think that's the right one to point to for sure.
yeah. Who do you think is going to fall out of the top 10 though?
That's a good question. I just think among the tail end there, that 8, 9, and 10, historically, what you'll see somebody jump in, like ARK Invest, I believe at one point jumped into the top 10 and they came out, so they
Mhm.
supplanted somebody. But towards that bottom end of the top 10, the VanEck of the world, and you've had ProShares in there. I just think those are constantly going to jockey around for position. I don't think anybody who's there is going to have some huge drop down the leaderboard. Um, and I look at some of the other issuers, or I actually think they can move up. Like Fidelity is somebody who, would you say they're at 8 or 9?
They're
I
at nine.
think, okay, so I actually think Fidelity's one where I think they have a lot of upside potential because they've done a really good job of embracing their actively managed roots on ETFs. They have index-based products, they have crypto products. How many asset managers are able to execute on all three of those areas? And Fidelity has a huge name brand, advisor distribution. You're going to have the mutual fund to ETF or the mutual fund ETF share classes, which would benefit Fidelity. So I see them as one that can move up. But it would just be like if Capital Group jumps into 10 or 9, then clearly a Van Eck or whoever's the bottom would fall down. I think it's that simple. I
I
don't
could
see somebody who's
I could
just not
actually see Van Eck
executing.
falling down. I could also see First Trust falling down, not necessarily falling out of top 10, but I could see First Trust slipping in these rankings.
I could see that a little bit. I mean, their ETFs tend to be more expensive, but they do such a good job. They're wholesalers. They get out and they're in front of the advisor community. They do a great. I'm just telling you.
It's
Uh,
funny because that's like some of like the nitty-gritty behind the scenes type of stuff that happens in the space that people don't really talk about too much.
yeah. So fun discussion. It'll be interesting to watch.
Yeah, I'm excited. I think we need to come up with like a debate of the month or something like that from now on. We'll just pick a new topic to go at it and see what we come up with. But that's it for this week's episode of ETF Pulse. We'll see you guys next week.